What is going on, traders? So back in April, at the height of the tariff uncertainty, I was being asked, why am I going to buy stocks here if I thought that stocks were going to drop further? And I said, simply answered, my job as an investor is to recognize that at certain levels, it becomes more risky for you not to buy. As the S&P 500 has rallied 38% from that bottom, most of the Mag 7 has either made all-time highs or are close to all-time highs. And the S&P 500 valuation based on forward PE is similar to what we saw in the dot-com boom and bust. The question now becomes, is it more risky for you to buy here than it is to wait? And if you care about your money, how should you tackle the markets right now? I promise to answer that for you if you give me a few minutes. Let's get right into it. Let's first take stock of where we are currently. The Fed cut rates on September 17th, cut by 25 basis points. And what they were concerned by the most was weakening job market. Their concerns over the job market definitely overrode their concerns over inflation. We have two more Fed meetings this year. And as of now, October 29th, there is a 25 basis point cut that is priced in. And December 10th, there is another 25 basis point cut that is priced in. This will take the federal funds rate target to 3.5 to 3.75%. This is very much in line with what the Fed projections are based on the dot plot. The Fed projections are 3.6% for the federal funds rate. When the Fed waits for a period of at least 5 to 12 months in between cuts, it signals that the Fed is actually not in a panic. And that is why typically we get positive returns for the following year. And moreover, when May, June, July, and August have all been positive and we have had a 4-month winning streak, look at the returns 9 to 10 months later. 21 out of 22 times it was positive. But I want you to take a look at something more interesting here. 12 months out from that 4-month winning streak, this is the max drawdown, meaning the most that the market was down in between the 12 months after that 4-month winning streak. So although the 12-month return is mostly positive, after the 4-month winning streak, it is not without volatility. This is the max drawdown. And it's no secret that right now valuations are insane. I've shared this with you before, but JP Morgan has calculated this. The 10-year returns, when we look at it annualized, when the S&P 500 is at a 23 or greater forward PE valuation, are between -2 and 2%. But if we look at individual years, meaning what could happen within a year of being at this valuation, we have had 1-year returns of almost 40% in the past. And there are a ton of dot plots here that are in double-digit territory returns when we are at this valuation and we are talking about 1-year returns. So that means at these valuations, similar to what we saw in the dot-com bubble, you can have extraordinary 1-year returns. 2025 is looking to be one of those years. 2026 could be one of those years. But in general, we are dealing with in a territory where the 10-year returns are not great at these valuations. Now, based on the fact that we are definitely in a bubble, this is an AI bubble, a technological revolution, similar, if not greater in importance to what we saw during the dot-com era, this bull market can last another 1 to 3 years, in my opinion. You could see that we are already on a very similar path to 1998. And it looks like if we are going to follow that path, we do have another 1 to 2 years of a bull market. And if we take a look at the forward PE and we compare it to the earnings per share, meaning the actual earnings, the valuations are still below what are the projected earnings. It's when this blue line, which is the forward PE ratio in a percentage base, gets well above the earnings per share, which is the orange line, as you could see here or you could see here. That is when we start to get into trouble because the companies are no longer reporting the earnings that they are expected to, or forward guidance looks pretty meek. So what does all this mean with regards to you, your money, and your investments? In my opinion, this is not the time to be reckless or to be unaware of what your current situation is. So what is your time to retire? How many years or decades do you have left in the market? If you're someone on the younger side, there are bigger risks that you can take here. If you are someone that doesn't have that much time left to retire, there is a lot to think about. And it is also not the time to mix your swing trades with your investing thesis, right? There could be a lot of money to be made on speculative companies like Big Bear AI or like Oklo, which is in the nuclear energy space. This company is pre-revenue. revenue. It's not even making revenue. And it's already trading at $135 from a SPAC price of $10. Playing around with these stocks is very different, for instance, from buying something like AMD, where if you do have a positive thesis on AMD as the second leader in GPUs, gaining more market share in the GPU space as NVIDIA struggles to fill all of that demand because we are in an AI boom, and you think that AMD is a good investment for 20, 30 years down the road. These are very two different things, right? Trading something like an Oklo or actually buying AMD for the long term, these are very different scenarios. Another thing is value. Are you getting the value in the market currently? So if you buy NVIDIA at 4 trillion, how much can you realistically squeeze out of there during the time that you have in the market? If you are on the younger side and you have 3 or 4 decades left in the market, yes, pretty much anything that you buy that is a mega cap right now will likely be higher in the future. I ran this exercise with the students in the Traveling Trader Academy, but I said, if you can go back to say 2007 and buy the top of 2007, not the bottom, but the top of 2007, would you buy it knowing that you wouldn't get your money back for another 6 years? It took between 2007 and 2013 just to get to the same place. So if you bought the top in 2007, you would have to wait 6 years to get your money back. But would you go through that if it meant that you would also be owning the S&P 500 18 years later at 6,600? The answer is yes, of course you would. So I have no doubt that whatever mega caps you buy from here, even if you bought the S&P 500 at the top, if you have 20, 30, 40 years left to retire, will you be okay during that time frame or after that time frame? And the answer is probably yes. So your situation is going to be very different from someone who has 5 years left to retire and is really pissed that they didn't catch all of these gains and is now going to dump all their money here. So with that said, in addition to knowing your time horizon and knowing your risk tolerance, it is extremely important to know what you are investing in and to try to find value here. I don't think from this point that every investment is the same. So investing in United Healthcare, something that is completely beat up, there is a lot of value on the table or on paper compared to something like an NVIDIA or something like an Amazon or something like a Microsoft at these levels. Now, it doesn't mean that you don't invest in those things. Of course, you want to hold those. But at this point, like I said at the outset, do you have more to gain than to lose by buying at the highs, or do you have more to lose than to gain by buying at these recent highs in the short term? And are you better off waiting for a potential correction before actually starting to load up on these things that are overvalued? And are you better served looking for value in this market? And where can you look for value in this market? So one of the things that you could do is use AI here. How many S&P 500 stocks are down year to date? Currently, there are 202 S&P 500 stocks that are down year to date. And there are 38 stocks in the NASDAQ 100 that are down year to date. Obviously, there are much fewer stocks in the NASDAQ 100 than there are in the S&P 500. And the NASDAQ is also very top heavy. And we know that those top stocks have really led the way in terms of this market rally. So there are still some laggards, and you want to look through these names at this point to try to derive value, in my opinion, until you get a correction in some of the bigger names that you can then add to your portfolio once again, or add more to your portfolio. So if we ask AI to give us the NASDAQ 100 laggards, you could see here that the Trade Desk, Lululemon, Marvell, for instance, Atlassian, these are all down year to date. Now, I'm not saying that you should be blindly buying these stocks. You still want to look within these, see which stocks align with your investing methodology, which industries align with what you want to invest in at the moment. So for instance, for me, when I look at Lulu, this, even though on paper, I think this is a great stock, it is not in an industry that I care about. If you guys know about athletic wear, I think that there's just too much competition there, especially in the women's athletic wear between Alu, between Athleta, obviously Nike, and some of the other ones. I just don't care to be in this space. But when I look at the Trade Desk, for instance, and I look at their growth rate and revenue, and I see that their CAGR is 39.4%, and I see that their net income is steadily growing, and their cash from operations year over year is really remarkable. You won't find too many companies like this. If I find that, for instance, I look into it and their moat is good and that they're leveraging AI for companies to make cloud-based ad buying platform more optimized, and I agree with their vision in accordance with their numbers, this is a stock that I might buy. In the Traveling Trader Academy, I recently did a deep dive into Marvell, the fact that it's trading at a cheaper than average 22 PE, especially for the chip industry. And I took a look at its quarterly revenue as well as its operating margin. As the AI and chip narrative continues to grow, I do think that this company in the future can be worth a lot more than it is today. And I think that there is a lot of value, or there is some potential value to extract out of this. Now, so far, we're just talking about investing here. We're not even talking about swing trading, which in swing trading, I'll trade anything if the opportunity is there. It doesn't mean that I'm buying and holding that for the long term. I'll even trade companies that I don't really believe in for the long term. So for instance, if I see a breakout here on Big Bear AI, no shade to some of you who might be really bullish on the company. I'm not, but I would still trade this breakout to get to this level, for instance, and I would take profits, within days or weeks after entering this position, for instance. I do think that you guys should be keeping a separate portfolio for investing and trading. You should not let one inform the other. And if you keep them in the same portfolio, I promise you're going to start making decisions in one based on the decisions that you make in the other. Now, sometimes you could be bullish on a company but also have a swing trading mindset to it with the intention of buying it if we do get a retracement. An example of this would be Amazon, right? I'm comfortable in saying that Amazon will likely get to that 242 level in the next few weeks or by the end of the year. But it doesn't mean that I think Amazon is a great buy here for the next 5 years. If you have 30, 40 years in the market, yes, buying Amazon here, you'll probably be fine, as I showed you with buying the top in 2007. But the less time that you have left in the market, the more you have to lose by buying at these valuations, in my opinion, and you have to really be picky with regards to finding value. This is why it's really important to frame your investments like this when we get to two extremes. Is it more risky for you not to buy when some of your favorite stocks are down 30, 40%? The answer is yes. Is it more risky to buy these valuations when you don't have a ton of time left in the market? The answer is yes. And this is probably why we now have the most money market funds ever, not only in terms of actual dollar value, but in terms of percentage of household assets. Because I think that a lot of Americans would rather get that 4 or 5% out of a money market than take their chances with this type of valuation here at this time. Now, so far, the Fed rate cuts here are looking more like what we saw in the late 90s, right? As long as the Fed doesn't slam the rates down to zero or near zero out of fear, then the market should be okay. But if we start seeing an unemployment tick up to above 4.3%, especially if we get above 4.5%, then I think that the Fed is going to act more aggressively beyond what their dot plot says. And I think that they will not be able to wait until 2027 to drop the rates down to 3.1. This right here is a perfect case scenario, right? If the Fed just starts to cut, or the Fed continues to cut very briefly and waits a long time in between cuts, then I think the markets will be okay for the next 1 to 3 years. But if this starts ticking up and we see it aggressively go up due to a black swan event, due to AI taking jobs, due to more jobs revisions, whatever, that is when the Fed will have to slam rates down. And I think that that is what will cause the next crash. But so far, I don't think there are signs of that happening. And this bull run could run for another 1 to 3 years. It's also important to note that when we talk about boom and bust cycles, it doesn't mean that once there is a bust, that's it. As a matter of fact, all the internet companies that were traded up here into these extraordinary valuations, once we had a bust of this, right, the companies that remained became the biggest companies in the world. The Amazons, the Googles, the Microsofts, the Apples, right? They ended up leading the way. And the same thing will happen to AI, right? You will have the NVIDIAs, the hyperscalers, the ASMLs, etc. Like you will have those companies lead the way along with some of these speculative AI companies. And then in a few years, we will have a bust of this. But it doesn't mean that AI is dead. It just means that the current hyperwave is going to bust, the ones that remain will likely take us to the next frontier of technology. And those companies will be worth a lot more than they are today. Like Nvidia could actually, in 10, 20 years, could be worth $8 trillion, double what it is today. So between now and the end of the year, who knows if we get a correction? A lot of us, including me, thought that, hey, August, September seasonality, we might get a nice correction for us to jump back on the boat in some of these big names. And on September 19th, we just had OPEX, right? It was actually a quad witching day. Now, a lot of people think that on quad witching, the stock market is volatile, but it's not until a week after quad witching, when things are rebalancing and settling, etc., that we tend to get some volatility. And although swing trades are always on the table and we are always swing trading, in terms of investments, let's see if we do get a pullback within the rest of September leading into October for us to potentially ride the next 1 to 3 years of the bull market that we are currently in. Now, if you want to know what it is that I'm looking at in terms of the value, as I said, we want to find value in this type of market. Click the link in the description below. You'll get all of my up-to-date analysis on stocks that I'm looking at and where I think the market is going as well. And we also do shorter term swing trades and day trades to try to exploit the market's directionality and gain income from the market. So not only are we investing, but we are also trading. So join me as I go live every single morning at market open, give you the list of stocks that I'm looking at, the day trade setups that I'm looking at. And if you're only interested in long-term investing, there is an option for that as well, a much more affordable option down there as well. Subscribe to the channel, hit that notification bell, stay safe out there, traders. Peace.